In this video, we'll talk about CVP analysis and the margin of safety. What is the margin of safety in cost volume profit analysis? The margin of safety is a measure of risk, the risk that sales decline to the point where the company is no longer profitable. The margin of safety is a measure of how far sales could fall before the company is in a loss position. The margin of safety is therefore a measure of risk, of how close an organization is to the danger level, a level of sales that is close to the one which will result in a loss. The lower the margin of safety, the more carefully the organization must monitor their sales and control costs so that they do not end up in an operating loss position. How is the margin of safety measured? It's measured as the difference between the current level of sales and the sales at the break-even point. The greater the difference, the more sales will have to fall before the company is in a loss position. Therefore, the greater the margin of safety, the lower the risk, because sales would have to fall far further in order to end up in a loss position. We can measure the margin of safety in three ways: units, sales revenue, or as a percentage. Let's use an example to demonstrate all three. David Inc. is a company which manufactures XD2. The company has the following information available for their product for the month of November. Actual sales, 2,000 units. Selling price per unit, $1,100. Per unit variable costs, $730. The contribution margin, calculated as sales revenue less variable costs, is therefore equal to $370 per unit. Total monthly fixed costs, $430,000. The formula to calculate margin of safety is as follows. Actual or expected sales less break-even sales equals margin of safety. To calculate it, both amounts can either be sales revenue or both amounts can be units. We'll start with units. Step 1 is to calculate the break-even point. We'll use the contribution margin approach. The formula for this approach is as follows. Q, meaning quantity in units, is equal to total fixed costs plus operating income, all divided by the contribution margin per unit. Recall from our past video that if we are calculating the break-even point, the operating income is set to 0. So, using David Inc.'s information, Q is equal to total fixed costs of $430,000 plus operating income of 0, all divided by $370, the contribution margin per unit. Q is therefore equal to 1,162.162 units, which we round up to 1,163 units, rounded. We already know that the actual sales volume is 2,000 units, so we can move on to step 2. Calculate the margin of safety using the formula. Actual or expected sales in units less break-even sales in units equals margin of safety. For David Inc., actual sales is 2,000 units minus break-even sales of 1,163 units is equal to 837 units. So, what does this mean? Remember that the margin of safety is a measure of risk. The lower it is, the closer the organization is to suffering an operating loss. If the margin of safety is large, then the further away the company is from being in a loss position. The margin of safety here is 837 units, which is a very high margin of safety, almost 50% of the actual sales. So, David's risk of suffering an operating loss due to fluctuation in sales is low. It means that sales would have to fall by more than 837 units before there is an operating loss. We can also express the margin of safety in sales revenue. Again, we'll use David Inc. and the formula. Step 1 is to calculate the break-even in sales revenue. We can use a shortcut to calculate this. Break-even in sales revenue is equal to break-even in units, which we already have, multiplied by the sales price per unit. David Inc.'s break-even in units is 1,163 units, rounded. So if we multiply 1,163 units by $1,100, the sales price per unit, we get a total sales revenue at the break-even point of $1,279,300. Since we have the break-even in sales revenue, step 2 is to calculate the margin of safety using the formula. Margin of safety is equal to actual or expected sales revenue minus break-even sales revenue. We have the break-even in sales revenue of $1,279,300, but we need the actual or expected sales revenue. How is that calculated? We can calculate that by multiplying the sales revenue per unit of 1,100 by the actual number of units sold, which is 2,000. 1,100 multiplied by 2,000 units is equal to $2,200,000. We can now use this information in our formula. Actual sales of $2,200,000 minus break-even sales of $1,279,300 is equal to $920,700. This means that sales would have to decline by almost $1 million before the company would suffer an operating loss. Again, we're demonstrating the low level of risk that David Inc. is exposed to, if their actual level of sales revenue is $2,200,000. However, what if management would want to have a better understanding of how safe they actually are? They would then calculate the margin of safety as a percentage. The percentage would tell them by what percentage does sales have to fall before the organization suffers a loss. This is done by simply dividing the margin of safety, either in units or sales revenue, by the actual or expected sales, again, either in units or sales revenue. The formula is as follows. Margin of safety percentage is equal to the margin of safety divided by the actual or expected sales multiplied by 100%. Again, we can use units or sales revenue. Let's use units first. Margin of safety is equal to 837 units divided by 2,000 units multiplied by 100%, which is equal to 41.85%. We'll talk about what that means in a minute. First, we can also calculate the margin of safety percentage using sales revenue. The formula would again be margin of safety percentage is equal to the margin of safety divided by the actual or expected sales multiplied by 100%. Using the information we have, the margin of safety percentage is equal to $920,700 divided by $2,200,000, all multiplied by 100%, which is again 41.85%. Notice that the margin of safety percentage is identical, regardless of whether you use units or sales revenue. What does the margin of safety percentage of 41.85% for David Inc. tell you? It tells us that sales would have to drop by 41.85% before the company would incur an operating loss. This tells us that this company has a relatively low level of risk because sales would have to fall by a large margin, almost 50%, before the company would suffer a loss. In fact, it shows us that the higher the margin of safety is, the lower the risk that the company will end up in a loss position. It tells us, using an example, that the margin of safety is a measure of an organization's risk that they will fall into a loss position. Clearly, the margin of safety is an excellent measure of an organization's risk. That's it for margin of safety. As always, thanks so much for watching.